Hello, and welcome to another episode of the Macro and Flows Update. It is May 16th, and here we are. Last Macro and Flows Update, we were pretty clear, starting May 1st all the way up to May 15th. Yesterday, you could expect a positive, supportive trend in the market. We have gotten exactly that. The big questions were around the Fed and CPI. And I said, if those things are neutral to positive, expect some significant strength, rally back. And based on relative to how supportive those flows are, right? The question was, if they're strong enough, we will, work forward from there and be much more, I would say, bullish on outcomes. Sure enough, that's what we've gotten. Vol is very, very, very well supplied in the market. That is going into the summer with Memorial Day and then end of month, beginning of month, positive flows into a positive, what we've had as a positive month with, again, vol supplied skew very low, so easy to hedge, a relatively accommodative Fed, administration that is working behind the scenes to provide liquidity and kind of goose the markets in the form of, Freddie Mac and Fannie Mae, rule changes, other measures that are kind of, again, seemingly small, not down the middle liquidity, but very potentially stimulative. All these things are very supportive. And never mind, at baseline, if markets stay consistently well supplied, the path of least resistance is higher, just based on Vana charm flows, buybacks of stock, all the market machinery that we know that naturally pushes things higher. We've referred to this in the past as the summer of George. This has been good 3 years since the last summer of George. Why do we call it that? That's the summer that's the time when vol is so well supplied that dealers, when the market goes down, have to buy. When the market goes up, have to sell. There's limited actual upside despite a positive trend. Think 2017. That was a classic year of this type of action. Vol was so well pinned at the index level that the market literally had nothing bigger than a 3% pullback the whole year. And it was just a very low vol, consistent march higher. That's the type of action I would expect. Not that low of vol, not that extreme, but that general view. This vol implied volatility is very well supplied, both through structured products and now zero DTE and all the things that are supplying that vol short term. In the index. That's also an important takeaway. Why is that important? Because that actually that creates dispersion. In 2017, as an example, we saw for the time record low correlations in stocks. In 120 years of history, it was the lowest implied vol by 30%, but it was also by 20 to 25% the lowest correlations. And again, in 125 years of index history, the single name correlation was lower than it had ever been. Why is that? Why would that happen? Why are those two things related? Again, we've talked about this, but to those who haven't heard it before, that is because the index vol is pinned. When the market goes down, the dealers have to buy versus the vol. When the market goes up, they need to sell versus the vol. That pins the index. But stocks like NVIDIA and other stocks still are going to move big. Those aren't the vol centers based on idiosyncratic risk. When they do, the index itself, if it's pinned, will force other things to move in the other opposite direction. And so you get a double effect. So a move up in something will push a move down, and that drives a breakdown in correlation. This is an arbitrage constraint. The indexes ultimately have to add up to the single names of the index have to add up to the index. So if something goes one way, things have to go the other way. So we believe this will drive dispersion, which is what that's called. And you'll see massive rotations this summer in a liquid market. What will rotate which ways? I think the best clue is looking at hedge fund exposure, positioning in a liquid market. Wherever the positioning is represents potential supply or demand. If entities, hedge funds or other entities are massively short, that presents reflexively buying pressure into those products and vice versa. So I think you're going to see a trash dash. Things that, look at those hedge fund hotels, wherever they are long or short, I would be generally playing the opposite. I think this will be a difficult summer for hedge funds and other entities that are long short, as they are essentially supply and demand in the market. Not just true for hedge funds, but other entities as well. Again, you really want to be playing long and short opposite those books, as well as other books. I think we're going to see, we had some clues through the meme kind of push in a couple entities randomly a week ago or so. I think those are a clue that narratives are going to come and go and push things in silly directions, particularly if there's supply and demand on the other side of it. So I would be looking for impetus through social media and other entities, Wall Street Bets, to push names, particularly names that are poorly positioned for other entities. I think they will go after names like that once again. I don't think it will be a 2021, 2022 redux necessarily in terms of meme runs, but there will be some. It will rhyme a bit after this kind of period of Memorial Day and end of the month flows that are supportive. Behind it sits early June, which is very slow. And then after June OPEX, and by the way, that early June will be slow, but it will have those decay of the June OPEX, a quarterly OPEX, which should be broadly supportive in those first couple of weeks of June. Then we have the Fed meeting on June 12th. And I think that slow grind will kind of, to slow grind to sideways action after NVIDIA on May 22nd through that period. And the vol compression will, I think, eventually on the Fed now push to, add for likely another potential push. But then that again will with the JP Morgan collar coming at the end of the quarter, lead to, again, vol suppression throughout the July 4th holiday and July. And so we could really have a long summer here of vol compression. I think that is the major theme, and dispersion would be the corollary to that. From a macro basis, this doesn't change the big picture. The big picture is higher for longer, sticky structural inflation, even though we got a bit lower number. I think the more markets grind higher and the economy does well, and the summer is a supportive summer with fiscal stimulus, I think inflation will continue to bounce and be, if anything, sideways to up from expectations. I think that will eventually lead to the 10-year, which has had a little bit of a pullback, continue to work its way and grind slowly higher. I think the fourth quarter, once we get there, into Labor Day, you can start to, you'll probably see an August pullback of some kind, and then we could very well see a Q4 rally into the election and out of the election. I think, numbers to look for, I think 55.75 to 5600. That area is would not surprise me if we were teasing that general area, if not hitting it and then backing off a bit in the end of summer, and then into the fourth quarter from some type of pullback, then seeing all the way up to 6,000. This market has legs. I think this after the summer of George, long dated calls will continue to work. But I just think those long dated calls need to be pushed out a bit further, meaning September through December, January, February. If you own them, and then you really want to be funding those, because vol will be very compressed in this earlier summer period, where vol is cheap, but will continue to force low vol outcomes. So that should be the primary focus. Monetize what you can now. Play more from the short vol side, shorter dated, and don't be afraid to own some longer, significantly longer dated calls. Again, maybe even in 2025 as a hold, even though they're higher vols and the curve is upward sloping. We do believe those things will maintain their value, as we go forward relative to these other things. Again, on their own, outright, those long dated calls are not a buy, because vol will be, we're going to lose essentially 3 months this summer. And that's a lot of decay, even for something that is 9 months to a year out. So again, focus on dispersion and rotation more than beta. Play long and buy dips. But also, unlike just buying dips and looking for convexity, we would be much more in the camp of buying dips and selling rips, and continue to play from the long side, but trading this very low vol market during that time. So in the meantime, no better time to be water, to not sit and stare at your screens over the summer, but be, again, focus on these core trends and don't get chopped up. Wishing you all the best. Be water. Take care.
This does not constitute an offer to sell, a solicitation of an offer to buy, or a recommendation of any security or any other product or service by CPI or any other third party, regardless of whether such security, product, or service is referenced in this video. Furthermore, nothing in this video is intended to provide tax, legal, or investment advice, and nothing in this video should be construed as a recommendation to buy, sell, or hold any investment or security, or to engage in any investment strategy or transaction. CPI does not represent that the securities, products, or services discussed in this video are suitable for any particular investor. You are solely responsible for determining whether any investment strategy, security, or related transaction is appropriate for you based on your personal investment objectives, financial circumstances, and risk tolerance. You should consult your business advisor, attorney, or tax and accounting advisor regarding your specific business, legal, or tax situation.